Today, I want to talk about volatility, specifically what happens after you have an event that is provoking volatility. But it's pretty well known that anytime there's an event that's coming up, particularly one that has the potential to disrupt the market, the Fed's going to be releasing their minutes or doing a rate hike, or there's going to be a CPI or a big jobs report or something like that. Leading up to that event, implied volatility of the underlying index or whatever's being affected by that event continue to rise right into that event. Just keep on rising. And then when the event happens, everything will just spill over. Volatility falls off a cliff. They call that volatility crush. So those are relatively rare occasions. There are other times when you have that kind of volatility crush falling off of the cliff. And you also have minor events like that. Every day, every morning, there tends to be a bunch of volatility in the market, and then it falls off in a relatively ordered way, I would say. So volatility rises into the morning, the market opens, kind of rolls over, and then comes down. And then it kind of stays steady for most of the day until we get to the last hour. Some people call that the power hour. And then it rises up a little bit more, but not quite as much as in the morning. So we deal with these times as options traders. And generally, volatility is kind of like the lifeblood of an options trader, and particularly those that are selling premium. When we have volatility, that inflates the premium of an option. And from a seller, that's something that you want to see. And the reason for that is that, well, depending on how you're looking at things. Here's an example. Now, a butterfly, that's what we primarily trade on 0 DTE, and we trade it for a very specific reason. It's a very flexible strategy. You can make it as wide as you want or narrow. You can trade it at the money or push it out of the money. We like pushing it out of the money because we get a nice risk to reward, a nice asymmetric return potential, so we push it way out of the money. The other nice thing about it is that it's really great at collecting premium, and particularly with the 0 DTE, or the very last day of expiration, we like that in particular because on that last day, premium is decaying at an exponential rate. And if it's decaying at an exponential rate, that means that it's inflating our butterfly at that same exponential rate. So that provides all kinds of benefits. However, volatility can sometimes either help your cause or work against it. And so you have to be prepared for what can happen with your strategy. Now, fortunately, because it's the very last day of expiration, volatility has an effect, but only for that first half of the day. Unless there's an extremely impactful event that's coming up, like Uncle Jerry, chairman of the FOMC, gonna do a rate hike or have some kind of presser, something where he's going to say something impactful. Or there's a bunch of Fed governors all on their speaking tour, and they're going to come up in serial fashion and bombard the market with their wisdom. So anything like that is going to tend to make volatility rise right into that event. So let's take that first case. Economic reports that happen in the morning. Usually they come out around 8:30. The CPI is a good example of this. Volatility will rise right into that. Then after the report, the volatility might hang around for a little bit. The market opens a little later or an hour later, and then it drops off. But it could also drop off well before the market even opens. So in that case, you want to get ahead of that. And the reason why you want to get ahead of that is that you want to buy your butterfly when volatility is elevated, because that will mean that you can get a better price on that fly. That elevated volatility will tend to rise the whole butterfly up so that there's a smaller risk to get into that butterfly, and also potentially give you much more profit. So it's all around good. You can generally trade a much wider fly, push it, and maybe get it closer to the money and get it for a better price, depending on how much volatility has risen. Then once you're in the fly, volatility will drop. And because butterflies are said to be vega negative, meaning that they increase their value when volatility goes down, they like dropping volatility. If you're in that fly, the dropping of volatility will cause the premium to decay faster and go up. Now that's good in the first part of the day. Once you get to around 2 o'clock, 2:30, something like that, time starts taking over. Volatility can't compete with that short period of time and the available premium left in that contract right to the end of the day. No matter what, that's going to decay. You can't stop that. No matter how much volatility you inject into the market, you can't stop it in that last hour and a half or so. It's just not going to happen.